Welcome back, Dan Weston's channel. It's been a spell since I have done an actual video. I know it's been a while. I've had a lot of fun doing like live streams, and I don't know. I like to screw around a bit, have fun. So, anyways, this will be the next ETF. So I've hinted at this. I think this is really interesting. So everyone, I guess I was looking through JPMorgan's ETFs, and I have a different in my factor Roth portfolio. I have a different ETF product from them, and I noticed this one, and I looked into it more, and I'm like, this is an interesting fund. So I try and present. Uh, if you haven't noticed, a lot of the ETFs I've presented as reviews are ETFs that I think could provide you alpha to the S&P 500, right? What's the point if I don't think it's going to beat the market? Why even consider it? Because these all are more expensive fees. These funds, these factor investing or active investing funds, like all of these will cost you more fees, right? So of course you demand better than the market return in exchange for that. So let's open our eyes to this. Now, at the end, we'll talk about my next one because I'm going to do another one pretty soon because of recent events with YouTube Finance. I feel like I kind of just want to do another one that popped up because I can. So, anyways, this one, JP Morgan Global Select Equity. Okay, give me a second. I have a slightly new setup, so it's a little annoying. But so the benchmark, before we start, the benchmark of this ETF is not an American benchmark. So this is a little different. So this benchmarks the MSCI World Index. Okay, that's the benchmark fund for this. So now we're going global, right, as they say. So we'll get into more of that. So if you look on the cover, you can see this is. I almost want to categorize. I should create my own categories, honestly, because I think active and passive are not the right way to look at ETFs. I'll probably classify them myself because you've got active managed to me, you have a factor investment fund, and then you have passive, which means it just blindly follows an index. I think those are three primaries. So there's a little more nuance. This is an active portfolio. It's run by two people at JP Morgan with more to that, which we'll get into. Okay, so number of holdings, you'll see it's not that much, right? 72 currently. Turnover ratio 8%. I don't think you can draw a lot from that because this fund is so new. As you can see, this fund came out last fall. So you can't this doesn't matter. It's not enough time because this could very easily go higher than this. We don't know. Top 10 holdings. So you'll see a lot of American companies. This is a global ETF. However, if you look as with any, if you market cap weighted the world, 60 something percent is US. So this isn't market cap weighted, but you see these are the holdings you see. I mean, a lot of tech, a lot of companies that you recognize. There is some international. So we'll get into what they're doing with this soon. Here's some of the breakdown. You can go to the website and see. You can see they're pretty diversified as far as their sector exposure. Not bad. Okay. So we get in new country allocations. That's more important, I think, to this when we look at it. So the prospectus will give us some light on what they invest in here. So you've got more, which is interesting though, more allocation North America than, let's say, VT or something. So it's kind of interesting. Again, this can change. We only have data from last fall to now because it's a very new fund. So bear that in mind when you look at statistics on this fund because it's not even a year old yet. So some of this I wouldn't even consider. Okay. Overview. What else do I want to talk about before we move on to the more interesting stuff? Okay. So here's their quick snapshot delivery for you. This is their little 2-second speech. Broaden your borders with this equity in your portfolio. Seeking to invest in the best ideas globally. Okay. JGLO. I got to admit, kind of the reason I wanted to do this is because of the ticker. That's a solid ticker, JGLO. I don't care who you are. And I hope you appreciated the thumbnail. You're welcome. It's really hard actually to find photos of Jamie Dimon partying. It's funny. You got to kind of scour the internet. He's not any like, he's very well, he's the GOAT of banking CEOs or CEOs in general. It's like you don't find a lot of photos of him like laughing and or in a party setting or something like that. So he's done well in his career. All right. Deeply experienced portfolio management team, have a combined 50 years. We'll show you who they are. Insight, 80 plus research analysts globally, covering 2,500 companies, averaging 19 years in the experience. So what they're selling you on is this is JPMorgan's best ideas. So this is like they have two very long tenured experienced portfolio managers. They have access to the entire network of JPMorgan, and they provide you the best, which we'll find out later, 70 to 100 company ideas that are in this portfolio. So this is, it's interesting because this is like the comparison is actually, I would say, to ARK, right? So ARK is Kathy Wood and her team's best ideas for innovation, right? But there's some factor investing wrap to her. It's not just her best ideas. It's also her ideas wrapped in this innovation blanket that you don't have with JP Morgan. So, but it's a fair comparison. So you're pitting two organizations against each other, ARK versus this fund. Okay. So everyone likes to talk about ARK. Here's a different one. They're like, all right, what are you getting? You're basically getting Jamie Dimon's organization in one ETF, which is it's kind of interesting. I have not seen a fund like this put together. So here are the two guys. So you can see they both are they have decades of experience. These are long tenured guys with JP Morgan. They are both, if I looked at their history, they are more international focused managers. So they ran funds in Europe, not the US, before they came to this. And I'll show you, actually, it's interesting what happened. They actually bought out or brought this organization on to run this fund. Okay. SEC yield, I mean, you're not buying this for a yield. It yields like 1%. So that's not important. The fees, though, I mean, you're paying this. This is pretty fair, I would say, from some of the other ones that I've shown you that are factor related. As long as you don't get up to one, like, so to me, like an active portfolio, you'll see stuff in the 0.3 to 0.7 range. That's kind of standard. That's fair. It's fine. I don't think it's excessive. If they perform the way they are, you would gladly pay this for what they're trying to do. Okay. So here's all the look at this. Just we'll run through this. I always forget to ramble through this because honestly, if you watch this later on, I mean, this will all change, right? They can turn over this fund whenever they want. They don't have reconstitution dates. So basically, this is their best ideas going forward in the market, and we'll see how the turnover, which I suspect that 8% will go up over time, because they're saying this is our best ideas. So I'll be curious over time to watch that turnover ratio, because if it keeps spiking higher and higher, I'm like, well, why, if these are your best ideas, why are you day trading these stocks more or less all the time? Or it would be concerning if it got too high. So you got a lot of names you see, right? A lot of names you're used to, like Microsoft, Nvidia, Amazon, Meta, Apple, MasterCard. So let's see, but we add now some flair of international. You've got Nestle. You've got a chemical company from Japan. What do you call it? Louis Vuitton. Hopefully I did not destroy. I apologize. We got a German company, Munchauser. I don't know. I'm sorry. It's fun. German's fun. Taiwan Semi, that has done very well for them, and they wrote an article kind of about that one. Novo Nordisk, that's done well recently. You see a lot of companies. What I noticed looking at this, a lot of these have done really well recently. So if this is their best ideas so far, it's looking like not bad. Okay. Honeywell, underappreciated, has done well stock. in the markets. You don't see YouTubers talk about it because it's kind of boring business, but so be it. AMD, Lisa Su, respect the GOAT. It's okay. So you can see that, go down it a bit. So here's the portfolio manager number one. Feel free to Google them if you want. I don't know what else you want to do. And here's number two. These are European hedge fund managers, portfolio managers, I should say. Sorry. Okay. So it's funny. They, the first guy, Helge, ran a Scottish investment trust. And this was combined with JPMorgan to create what you can buy JGLO today. So basically, they have some other products you can look at JPMorgan that were, included in this combination or merger. Okay. So we can look at performance, which is funny because you can only see, obviously, this is from 2022 before the merger with JPMorgan. If you remember, 2022 was not a great year. So he had a decent return in 2022. It appears, and that was a bad year for the markets. So okay, so limited data. There's not a lot to this. So these guys have from what I found, this is what they do: global investments, where they select companies they think will outperform and provide alpha to you, the investor. Okay, that's why they call it global select. So this is what these guys do. So quickly, we'll go over this performance before we go into prospectus. So far, and I know people, performance doesn't mean or anything in the future. Okay. So far, they've been doing what they said they're going to do. So they've returned since inception 28%. This is just stock return, not total. So they beat the S&P, but their benchmark is this one. So this is an ETF that is the MSCI World Index, Earth. You could buy that also, really. So they're saying that this is their benchmark to outperform, not the S&P 500. So they have outperformed so far Earth by 5%. So far, we're doing what we said we're going to do as a fund. Okay. So here's an article. I'll link this below. It's on. They have multiple articles under their JPMorgan Asset Management banner that a lot like their portfolio managers write these articles, and you can read them. So here's our guys wrote this. Taking advantage of global opportunities. So you can kind of get this is what these guys are telling you they do. The world is a pretty big place, narrowing it down the opportunities is no mean feat. You need well-researched global research platform, trusted, repeatable investment process that can identify the best opportunities. So they're saying, there again, we're using all these assets that are available to us at JPMorgan to provide you the best ideas that we have using our technology, and you pay 0.47 fee for this. We have strived to produce alpha across all sectors and regions. So we'll go the prospectus will tell you what they can invest in by sticking to what we know: stock fundamentals and risk. Okay. So this disciplined approach enables us to consistently earn high returns across a wide variety of sectors. Okay. Our investment process in action: fast growing in emerging markets. Okay. Our clients often ask us our views on emerging markets. So this would be a way where you're like, emerging markets don't seem very just buying all emerging markets doesn't seem very promising returns historically. So, that's one place where I think that a professional portfolio manager could give you a benefit of finding the better companies in that space. This is my opinion. So you could have a different opinion. We don't look for emerging market exposure in our portfolio. So they're not like, oh, we need some emerging market in this thing. They don't have to, right? They're like, there's no requirement in their prospectus. They have to have developed market, emerging market. It's best ideas, okay, for a return generating alpha for you. So Taiwan Semi is an example. They were highlighting this investment that you could see was one of their top, I believe, 10 holdings right now was Taiwan Semi. Largest chip maker in the world, 90% global market share, leading edge processor. This contemporary the industry is forecast to exceed. So they're talking about potential growth rates. So that was an example of a successful best idea for them, because if you go look at Taiwan Semi, it's been doing really well. So conclusion. Now this is where say you still want US exposure, but yet you recognize that there's a whole rest of the world, right? And you don't have resources to look in other countries necessarily because maybe you don't have an international brokerage account. Maybe it's tough to find news stories in other parts of the world, and then there's a time difference and you just don't have time for it. Well, these guys will find them for you, right? So, and they recognize, I like how they talk about the US. They don't think there's any, the US will lose its competitive advantage anytime soon, and their outperformance. But they think by ignoring the rest of the world in your search for alpha, you are missing on special companies. So this is like what I believe. I think you just straight up index in the US. I don't think there's an advantage to money managers, which has been proven statistically. But I think internationally, there's risks and considerations that actually I think would benefit you having someone actively manage those investments internationally, because now you have currency risks, right? You have political risks. If you just bought everything in the world, there's no recognition of that. If you had a complete world ETF, you would have not had assets pulled out of Russia when Russia invaded Ukraine, even though most people would have recognized the rest of the world would have treated Russia rather harshly, right? And we instituted different embargoes and protections, and which caused like Russian assets to be worth nothing. So if you didn't have a person there to withdraw that money, you lost all those investments. So those are risks that don't, if you're just a US investor, like you don't really have those as considerations. So we look, finally, the prospectus. Now, the first week, it didn't even download. I had to find it a different way from their website. This kept erroring. It was really annoying me. Okay. Funds' main investment strategies, primarily in equity securities. Well, yeah, obviously, I don't do bond funds. In global developed markets. Okay. So developed markets is primarily where these investments are. So if you've looked at a map of what developed markets are, some different companies have different opinions to some degree, like MSCI compared to State Street. But you figure it's like Europe, Western Europe, Japan, the United States, Canada, New Zealand, United Kingdoms, obviously in Europe, Singapore. I've seen Korea can be it could be emerging or developed world. Hong Kong's in there. So but that's their index primarily. So you can go to MSCI and see how the index is constructed, that this is what they can select from, the MSCI World Index. Okay. Fund may deviate from these exposures at the advisor's discretion. Remember, this is not factor investing. They don't have specific requirements of any sort. This is their best ideas picked from the world. Okay. Under normal circumstances, the fund will typically hold 70 to 100 securities. We already covered that. So a lot of this is just risk crap. Go down. Main investment strategy. The fund may invest in global emerging markets, global developed markets, and they list them all. Generally, the fund expects to maintain over time regional geographic exposure similar to those of its benchmark. Okay. Although the fund may deviate from these exposures, advisor discretion under almost circumstances. Okay, we said again how many holdings. In particular, this is here's something I like too. ESG integration does not change this fund's investment objective, excludes specific types of industries, or limits a company to the fund's investable universe. I like this. I don't like ESG. I don't like ETFs that push ESG. So I don't know if you're going to see me ever really do BlackRock, like iShares funds are tough for me because they are the ESG people. They created ESG. So if you ever want to invest, I mean, I would assume the vast majority of iShares has ESG in it, any ETF products from them. I'd be shocked if you found one that didn't. I mean, there might be some, but so this one, they do not consider at all anything ESG related in their selections of your investments. So if that is important to you, there you go. If you don't like that, then freaking buy anything from iShares and you're going to be covered. All right. So here is the summary prospectus, which is probably the better reading. Do you really need to read the prospectus? Half of it is just legalese stuff. The summary one usually covers what you need to understand. Okay. So again, like this is their best ideas. So some of this, it's not specifically listed in the prospectus what they're looking for because they can't really describe it to you. And it's not like the factor ETFs I've showed you in the past, you can literally just go to the benchmark or you can just go to the filings or the documents to show you this is how they calculate the things they're going to invest in, what they consider. Like for SCHD and G, they have very specific criteria that showed you how they selected the stocks they pick, right? Factors, not human touched. They take a big amount of them and they start paring down this big benchmark index till they get to the amount of stocks they want, right? Investment process. In managing this fund, the advisors focus on individual equity selection, emphasizing those securities that are identified as attractive according to the proprietary research, JPMorgan, the whole infrastructure of the advisors. This process looks for securities that the advisors believe are attractively valued, possess strong free cash flows, and have the potential for sustained earnings growth. They give you a little color of what they're trying to do. Advisors analysis includes a review of proprietary data, so JP Morgan's internal research platform and analysts, information self-reported by the companies. So their own buy, am I going to screw this up? Their own buy side analyst data, right? Sell side would be they're selling it, but this would be their own internal people. I think that's all I wanted to show you from this. We're getting a little far. 20 minutes was about what I wanted to do. So kind of the last point. So you get the idea. Like this is like there's not a lot to tell you what they're going to buy. It's JP Morgan's best ideas. Okay, that's it. The whole infrastructure of JP Morgan. So they've got, like they brag, they've got people in a lot of countries. They've got lots of analysts. So you're getting their entire infrastructure, right? And their best ideas, their 70 to 100 best stocks that they think you should invest in to generate alpha. So we will go. There was a few parts of his letter. This is Jamie Dimon's letter to shareholders in 2023. There was just like two parts I wanted to read out. So he talks about the size, which was on the main sheet of the ETF. They do business in 100 countries. They have people on the ground in over 60 countries. They have analysts, research platforms. They are market makers, so they get to see the flows of the buys. Another thing to consider. So you get all of that. You would hope, right? Because that's what they're selling you with this fund. You're getting Jamie Dimon's org, his group. And there's one more part I wanted to read. Okay. So yeah. So again, is this more emphasis? Like, okay, what is their organization? Here's some color to it a bit. JP Morgan Chase spends $700 million per year in extensive research coverage. Okay. This benefits you buying this ETF of nearly 5,200 companies. The benchmark ETF does not cover all those companies. Okay. Across 83 countries, this massive effort continuously educates investors and decision makers around the world and often leads to improved governance and management. It also critically complements a firm's market making activities. So they're seeing the flows of buying and selling. Okay. Now, wink, wink. Who knows if that benefits you? They'll never tell you. Further promotes transparency, enabling investors to make thoughtful choices. Okay. Backed shareholders know market making backed by 7 billion. Okay, that's not so much, but the 700 million. Okay, they are making huge, capex into their infrastructure for extensive research coverage. This benefits you. You're getting that benefit for a 0.47 expense ratio. So there's that. This was kind of just cool. This isn't really related to this ETF, but this line blew me away. First, over the last 10 years, the firm's market-making business has never had a quarterly loss and has only lost money on only 30 trading days. That's just blew me away the first time I read this letter when he published it. I was like, that shows you the power of that business. That's probably the greatest business in the world. If like Citadel and JP Morgan and whoever else does market making, man, it's probably the best business in the world, besides maybe like Apple's iPhone business. So there's that. So that is a coverage of this. If you wanted like a one-stop shop ETF to give you international exposure and has a chance of giving you outperformance of the S&P 500, but even though that's not what this is benchmarked to, it's an interesting option for you. I'm intrigued to watch it, and someday it could be added to my factor investing. I have a different ETF that covers just the international portion because it's a 4-fund factor portfolio that I have in my Roth. So I like it. It's very. I'm going to be interested in watching this ETF maybe over the next year, see how the turnover ratio changes. I suspect it's going to go up. So that'll be interesting. See if they can continue outperforming the two indexes that I showed you. So it's interesting. And like I said, a good comparison is like compare this to ARK. Okay, let's pull ARK up. This is Kathy Wood and her organization's best ideas for innovation. Okay. Jamie Dimon's crushing her. His org 28% since last September. ARK has been up 5%. So there you go. That's probably the better comparison for something like this. And I think you're paying less of a fee. So after this, I am going to do, okay, I'll just show you now. I usually keep these under, but I know there are so many channels talking about this. So I'm going to do it sooner than later. Don't touch me. So, you know, I don't like Yield Max. And what have all the Yield Max people done? All the Yield Max people have lost lots of money on Yield Max funds. So they all decided we're going to sell that because we're bloody red on those, and we're going to buy this because this is better because it pays weekly. And we will go over this in another ETF review or just a video. I don't know if I want to specifically label it as a review, but yeah, you could probably imagine what I'm going to think of it. But we'll go into it a bit because I see a lot of traffic on this, and it's the same mistakes. If you go see my Tesla videos, I'm pretty sure it's going to be the same conclusions because it doesn't matter, right? It doesn't matter the construct of the derivative strategy. The end is going to be always the same for the most part. So thank you for watching. Hope maybe you got something. Keep your eye on this fund. Maybe this is, I usually say core or satellite. I didn't put actual chart in here. This is not a core holding, right? It's higher expense ratio. It's not broadly diversified as far as holdings. It's broadly diversified in the regions, but I would not consider this a core holding. This is more of like a satellite holding in your portfolio. So take it for what you want. Thank you for listening and have a good night.
Thank you for your cooperation. Good night.
I'll buy that!